Good afternoon and welcome to Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. And it's the last Thursday of the month. That means I have Chris Englebert. He's the managing director of Beirne Wealth Consulting, joining me at Nasdaq HQ for our monthly RIA strategy update. First, we're going to take a look at what the market did over the past month, our outlook going forward, and stay tuned for the most important part of the session when Chris goes into best practices for the RIAs out there. Chris, as always, thank you for joining us at HQ.
Thanks, Jill.
All right. Well, October proved to be not quite too scary, but if we take a look at the S&P Dow and Nasdaq, the Dow actually led the way for October.
Yeah, absolutely. It's one of those things from a historical standpoint that traders watch, that if the Dow starts to outperform, it tends to send some negative signals versus the S&P 500 and the Nasdaq. So we're watching that. But like you said, typically the months of August, September, October tend to be weak. They were the opposite this year as the market almost continued its unstoppable melt up.
Well, do you think it's because the Dow really isn't representative of the full market, that when you see that kind of leadership, it's perhaps maybe a couple of stocks, 2-3 stocks that are really moving that index?
Yeah, absolutely. The Dow obviously is showing how narrow the market's getting. The other day when it was up 170 points, you had 3 stocks driving it. And so it really gives the average viewer looking at the markets a false sense of what's really happening. They really need to look at all the different indices in concert.
All right, and how about the small caps?
Yeah, small caps are a mixed story. They were really sending signals through the summer of kind of breaking down, and then we got into late August and they really shot up, and Russell 2000 showed some strength. But again, once, you know, where they're at this point in time, they might be signaling a little canary in the coal mine. And so we're watching what's happening to make sure that, you know, the breadth keeps expanding, which it doesn't really look like it's doing just yet.
All right, and let's pull up a chart on the bonds. This is the TLT, the popular traded ETF on the 20-year Treasury. How about that? Yields are kind of higher this month.
Yeah, it's almost, I hate to say, a replay of last fall. If you remember, right after the election, and people have short memories, there was a big pro-growth, talk, and the 10-year went from 180 to 260 in a blink of an eye. The 10-year started out the year at 244, and guess what? We're at 240, 242 right now. A lot of bond bears are saying that 240 was the magic line, that once bonds cross that line, yields would go higher. We got to wait and see. There's a lot of activity at the 240 level, and it looks like it represents good value for the current time.
Can you believe next week is the 1-year anniversary of the election?
Absolutely.
Just unbelievable, with the major averages up just about over 20%, with the Nasdaq leading the way. I mean, it's been quite a year. I mean, can you recall any time in your career where all 3 averages have been up 20%? No,
and again, to your point, what really is surprising is the investor sentiments continue strong from a positive standpoint, but we've literally gone over 265 days without a 3% correction, something else unprecedented. So we are concerned about the one-way nature. I talked about it a little bit last month that if you look at this market or these markets compared to other markets throughout history, we're almost getting a parabolic effect where the markets have just accelerated straight up, and that is a cause for concern.
All right, well, let's talk about our 2018 outlook, because we only have a couple more months to go with our monthly updates as we get into 2018. And guys, I just want to remind you, make sure you stay tuned for the back half of our hit as Chris gets into RIA strategy for 2018. But let's talk about the international markets, because they've been quietly performing in 2017 as well. What do you think for the next year?
Yeah, absolutely. In fact, everybody's writing their market comments for 2018 and their outlooks, and that's going to be a big theme. It could be the first time in probably 15, 16 years that we actually see leadership change to a more international bent. There's a lot of valuation metrics out there showing that obviously the U.S. markets are rich and international markets are still cheap. So we think that's one big story that plays out for 2018 is the continued strength in the international markets.
All right, and let's take a look at the 1-year chart of the VIX. That's pretty interesting. Now, you think that vol is going to increase in 2018, as you had mentioned before, 265 days plus, without a 3% correction. I'll tell you what, even if you look at that chart, you see some blips here and there, but you've really been in that 10 to 12 range all year.
Yeah, absolutely. And in fact, if people in my profession, we're always looking to, invest for our clients what's cheap and sell what's, rich. The cheapest trade out there is long volatility. I mean, there's literally been no volatility. So, again, the question, before we started here, we were talking a little bit about, the crash in 87. And again, by no means do I want to say that we're going to repeat that situation, but there was a lot of portfolio insurance going on at that time. And when that happened, everybody tried to head for the door at the same time. Now it's a little bit different that you have a lot of people short volatility. That's been the trade for the last year and a half, where they literally crushed volatility down to nothing. At some point that's going to change, and unfortunately we think people could be surprised when it does.
I also think with the type of money that you manage, being short vol might not necessarily be appropriate as well.
Right.
Perhaps the buy and hedge strategy makes more sense. So that's interesting to hear you say that. Now let's take a look at our final chart, courtesy of Bloomberg. The resurgence of the commodity sector was pretty quiet this year.
Yeah, absolutely. And again, if you're looking what's cheap and what's expensive, this chart really shows the S&P compared to a basket of commodities out there. I grew up in the Midwest, so I am very familiar with the agricultural commodities. We haven't seen beans in the teens for over 20 years. I mean, the surprise for 2018 could be we're only one drought away on a global basis, where you could see the agricultural commodities outperform. But more so, if you're looking again at oil and the oil-related commodities, they've been maintaining. I mean, everybody's been talking about, hey, there's a lot of oil out there. Well, if you look, the price of oil has stabilized pretty well for 2017. The only thing that really is the wild card is the gold, silver, the metals. Some of the base metals have started to perform better, but all those people out there that talk about gold all the time, it's done well this year, but it hasn't done as well as what people expected. But again, a basket of commodities compared to the S&P 500 is very cheap right now.
Well, and that's kind of concerning if you look at it from the consumer end, because commodities have been quite cheap this year, right?
Yeah.
So you will feel it at the pump, you will feel it in food prices. So I'm curious to see how that will impact consumer spend trends. But I want to ask you something that personally I care about. This 401k rhetoric, where we could potentially, I mean, the president said it wasn't going to happen, but
Correct.
to move that down to $2,400, that is my tax break.
Yeah,
what's your thoughts on that?
Yeah, the Rothification of the 401k, which has been the chatter the last couple of days, if I want to use the word, it would be disastrous. I mean, it's very difficult. We do a lot of 401k defined contribution business, and the big selling point is the fact that people are getting some kind of tax break when they save for retirement. You can see chart after chart of how little Americans now save for retirement. I think this would be a huge problem out there.
But also, too, with all this money going into 401ks and other retirement vehicles, who do you think is buying up these ETFs and the mutual funds, because they have a mandate to invest?
Yeah, absolutely.
And you might get, we were talking about it before, where it's a revenue neutral proposition, right? But that, I think, in my mind, that could potentially impact the markets. And if right now, as Americans, we're not as inclined or not as diligent with our retirement savings anyway, what are you going to do? We're living longer.
Yeah, absolutely. I mean, I meet with clients all the time, and we talk about planning for the last 20 years of their life. I used to run plans out for people to the age of 75, and I had a gentleman say to me one time, why do you only go to age 75? I'm like, well, that's actuarially how long you're going to live. Well, we had to change that about 10 years ago, where now we run plans out to 85 to 90 for people, and again, it's a big concern if they change the investment landscape for retirement.
That was like the conversation we had for September strategy session, where we were talking about asking those difficult questions with older parents, because people are just, in fact, living longer, and you need to know their financial position. So let's wrap it up with the RIA strategy session and looking at marketing tools going into 2018.
Yeah, so most firms like ourselves now are talking about what we're going to do for marketing for 2018. Obviously, we're always looking for new clients, and we think that we have the edge with a couple of tools. I had to laugh the other day. I got a postcard in the mail from an investment firm inviting me to another steak dinner. This day and age, people showing up to a free meal really isn't a way to gain quality clients from an RIA standpoint. I mean, it's really some of the ways that firms go about marketing for new clients, I think, unfortunately, is where they really need to improve.
So do you think it's more on the social end, sort of reaching out from a more digital peer perspective?
Yeah, absolutely.
So let's talk about your top 3 tools that you use for marketing.
Yep. Well, the one that I really like is a product called CardTap. Basically what CardTap is, it's literally my own app. It's very inexpensive for an RIA to get. You can design the interface so that your clients can call you. But really from a prospect standpoint, again, we do a lot of 401k meetings, so we get participants to download the app for either their Apple iPhone or their Android product, and it builds an interface for people to be able to get a hold of you, talk to you. I have my latest market comment on there. The second page is a way for them to access their account. So in this digital age, handing somebody a business card is obviously very passé because we get a lot of referrals. Our clients are our best source of referrals, and many of your clients go, hey, Chris is a great guy, but I forget his phone number. Well, if they've got your app on their phone, they can share that app with the prospective client. So we think that's something.
Do you find clients are more interactive now?
Yeah,
because
absolutely.
they access everything on mobile versus just waiting for their quarterly statements.
Yeah, absolutely. I mean, we found that our app has increased interaction with our clients, which is what we want. I mean, we're in the business to obviously manage their money, but also to educate them. I found that a educated client is the best client out there. They see something going on in the markets. They may text me, hey, give me a call. I want to discuss this, etc. That's really what this business is all about. Is managing the people's money, but really having a personal relationship and having them be able to get a hold of you and talk to you about what they're thinking at that time.
So our hit is going to go on this app or be distributed via social, I would imagine.
Yep, absolutely, yep.
All right, so let me ask you a question. Going back to client management, have you gotten an increase of, what do I do? My portfolio is up nice for 2017.
Yeah.
What do I do now? Should I put money in? Should I move to cash? How are you managing that?
It's literally the juxtaposition of March of 2008. I can kind of tell that we're in a little bit scary period of time because some clients that really are focused on the media are saying, hey, fear of missing out, should we be doing this? And it comes back down to risk management. The worst thing you can do is when you have a real momentum, sentiment-driven market, to let her fly at this particular time. So we're trying to constantly educate our clients on here's what's happening out there and here's why we think you said you're a conservative investor and here's what really conservative investors should be doing.
Right, so they take a look on TV and they're like, oh, the S&P is up 20% on the year.
Right.
Well, if you're in a more conservative portfolio.
Correct.
I mean, I remember we were talking about this before. It's like Series 7 101. You should be happy with this 6, 7, 8% return.
Absolutely.
And be able to sleep at night as well.
Yeah, absolutely. But again, that fear that we had in March of 2009 has totally gone away. Everybody's forgotten about that. And here we are, October of 2017, where people feel almost invincible, which is as far as their portfolios go.
Continuing to sell vol.
Right, exactly.
All right. Well, thank you very much for joining us at HQ. As always, and traders, be sure that you stay tuned for the last Thursday, November 30th, where Chris and I are going to talk about what we are thankful for in the markets. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.